Thank you for joining us for our final session of day 2 of Definity Academy. We are, excuse me, here with Dan Schweiger. He is our actuarial consulting manager for cash balance here at Definity. Before, I just have a quick housekeeping note. If you have any questions at any point during the session, please drop them into the Q&A feature. We will be keeping an eye on those throughout, and we'll leave time at the end to address as many as we can. So now I'm excited to introduce our speaker, Dan, who is our actuarial consulting manager for cash balance. And in today's presentation, Dan will walk us through how cash balance plans can serve as a powerful strategy for winning high value clients. So Dan, we are so glad to have you, and I will turn it over to you.
All right, thank you. Uh, when a plan sponsor, a financial planner, and a pension firm love each other very, very much, they express it by forming a bond. Through that lasting bond, a cash balance or traditional defined benefit plan is created. It is a miracle within the financial services industry. Now, you might have heard CPAs or financial planners talking in a dirty way about cash balance plans on a street corner late at night or in a locker room or whatever, but we'd rather you hear about it in a warm, caring environment at the Definity Academy. I'm Dan Schweiger. I've been a retirement actuary for 12 years. Prior to that, I was an assistant to other retirement actuaries for 8 years, designing cash balance and 401k combinations. So buying, selling, manufacturing cash balance and 401k combinations for quite some time. Okay. What is a cash balance plan? As you read that definition to yourself, let me give you a quick example. A plan is created tomorrow, which applies retroactively to January 1, 2025. By the way, under the CARES Act, a plan can be adopted now, retroactively to last year, if the corporate filing was not completed by the CPA for 2025 yet. Therefore, there are a good 7 weeks to adopt a new plan or set up two plans before the opportunity is missed for the 2025 plan year, tax year. Definity is filing extensions for current plan sponsors before July 31st, so new plan sponsors can also be on extension, fall in line with the other ongoing plan sponsors if they agree to enact the plan in May or June or early July. So, a plan sponsor decides, in our example, that he has a $100,000 budget for contributing to his own retirement plan. The long-term actuarial assumption has been determined to be 5%. So year one, it's December 31, 2025. The cash balance will be 100,000 because realistically the physical deposit was made like in May 2026 after the year is over. So the 100,000 was treated as a receivable with no earnings on it. Year two, it's December 31, 26 now. The opening balance of 100,000 picks up 5%, and the person has another pay credit of 100,000. So at the end of the second year, the cash balance is 205,000. Year three, it's December 31, 2027. The opening balance of 205,000 picks up 5% for 215,250 plus another 100,000 gets deposited for a total of 315,250. So it all kind of cycles through. We have a series of terms of 100,000 each that are growing with 5% for up to 9 years. The first 100,000 picked up 9 years of 5% compounded interest. The second 100,000 picked up 8 years of 5% compounded interest, all the way out to the last year, where the last 100,000 did not pick up any interest. That last deposit was made in, say, May 2036. The grand total of all of the cash balance plan in our example after 10 years would be 1,257,789. The other takeaway to drive home here is that cash balance plans appear to look like a profit sharing plan, but really complies with defined benefit laws. The pay credit of 100,000 got defined. The long-term interest rate was also defined as 5%. So psychologically, a cash balance looks like a DC account balance, but it was really a defined benefit plan after all. Next slide, please. Okay, so we can all do this arithmetic, okay? The key idea of this example is that we have a 48-year-old that is well paid, and this is the point where he should consider a cash balance or a defined benefit plan. Like if he earned 200,000 but only sponsored the 401k plan, he would still be maxed out at 72,000 because that is the 401k limit in 2026 under Internal Revenue Code 415C. Uh, Invariably, the overarching narrative that Definity seems to attract is, until I paid my law school debt, until I fell in love, made my house payments, until I set aside some money for my children to attend the university. Now, what am I supposed to do for retirement? I'm 48 or I'm 52. Now what? We do attract an occasional college basketball player who can overtake the $72,000 limit if his salary is 360,000. We do attract a 35-year-old that is proactive about saving for his retirement. We do attract a 60-year-old that started to save a little late, but by and large, it is someone around 50 with that narrative. So no problem. Let's make up for lost time, but we must make use of each working year going forward. Uh, so let's go to the next slide. In this example, we solve for a pay credit of 129,000 for that same 48-year-old who earns 190,000, and that far exceeds 72,000. We used our advantage that he is sponsoring a plan for the first time at the age of 48. The discount factor is that much larger as the participant approaches 62, like a 60-year-old would have a discount factor of a 1 over 1.05 to the fifth power, which is 78 cents on the dollar compared to a benefit payable at 65. The 48-year-old's benefit here is worth like 51 cents on the dollar compared to a benefit payable at age 62. Next one, please. Okay. Well, these key takeaways should be clear. I covered it earlier. Um, a cash balance uh, contribution can be much more than 72,000. That's the whole idea, especially if somebody is like 48 at least. And it gives the appearance of a 401k plan, but it's really a cash balance plan behaving with defined benefit rules. Uh, okay, next slide, please. So here we have a 28-year-old whose limit under the 401k plan is the aforementioned 72,000. Therefore, this illustrates the point that age is not a factor in a defined contribution plan. His allocation was the same as the 48-year-old. If we do the same arithmetic as the cash balance plan, except now the person is a 28-year-old, that discount factor, the 1 over 1.05, is 34 years away from retirement, not 14 anymore, and will get a pay credit of $48,645 or 25.6% of pay. So in that case, we would tell the 28-year-old would-be plan sponsor for the cash balance plan that it makes sense for him to defer the salary of the 24,500 because that's an employee contribution, like separate from employer contributions, and enact a cash balance plan since there is a 25.6% pay credit that exceeds the 25% limit on the DC plan. He should pay himself a bonus if Definity can get to him in December of the current year and not like May after the year is over. But whatever, we get to that when we get to that. Next one, please. Okay, so there's two types of non-discrimination testing I want to go over, just two of them. So now we've expanded our example of the 48-year-old, and he's got four employees. So that's our favorite benefit cost, 129,070 again. And the IRS rule mandates that 40% of the staff, namely two people, must have a meaningful benefit of at least a 0.5% of average pay. Clearly, the 48-year-old has it. In the previous slide, we used a maximum benefit rate to calculate his pay credit. If we do the same kind of arithmetic for EMP4, the 27-year-old, we would get a 0.005 times his salary of 25,000 times the discount rate from 62 down to age 27, and then the factor for a 62-year-old to live to 85 or so, and that arithmetic arrives to $305. So by providing $500, we are meeting the 401(a)(26) rule. We've got owner and we've got EMP4, both beating the half of 1%. So we know we passed this test. Uh, Let me tell you, the IRS is not dumb. If there was not a meaningful benefit in place, a wise guy would have a benefit rate of 0.0005 or 0.00005 and claim that $30 or $3 would be meaningful. So there is already an IRS definition of meaningful in place. So let's go to the next one. Okay, this is the second test I wanted to go over. And our group was only five people. So we're going to follow the branch of the second bullet that we need 2/5 of the NHCEs to be in the same rate group with the HCE. So, we have four NHCEs. 4 times a 0.4, which is 2/5, is 1.6 people. So obviously we need two. We have to round up the 1.6 to two people and have two people get a very high benefit rate. Otherwise, the plan design, if it's left as is, would be a failure. So then the contribution of the plan would not be deductible. Oh no, what are we gonna do? I'm freaking out. I don't know how to make the contribution become deductible. Proceed to the next slide. So this is the same table as two tables ago, just to refresh your memory. And we're making the comment here that an additional allocation in the 401(k) plan would be needed to pass the average test. So go ahead, go to the next one. Now, I want for everybody to read these standard mortality tables aloud with me as I read them to you. Starting with, I'm kidding. I imagine that some of you are mouthing them, but I don't really want you to. I'm kidding. Uh, the key idea is the IRS is very kind when the interest rate available is 8.5%, and there is a great deal of mortality tables to choose from. Let's go to the next one. Okay, so let's apply the 8.5% and one of the tables for this 22-year-old that got a 5% allocation. So he makes 50,000 a year. 5% of 50,000 is $2,500. So that 2,500 is being compounded for 40 years and arriving at a lump sum of like 65,000 or so. Okay. And then we divide by a mortality table factor. It's a 1984 table. So for a 62-year-old to live to about 79, and we get an annuity that's like 7,700. So we could show here that the benefit rate for this employee is 15%, 15.41%, and not 5%, which would enable passing the average benefits test. So, just a disclaimer here, there might be actuaries listening to me now and want to slap me on the wrist, like, no, the normal retirement age is 45, therefore it's 43 years of compounded interest. So this is a slide only. I'm not certifying this as an actuary. These slides are intended to give a concept or an idea of how the 401k allocation works in tandem with the cash balance plan. Uh, this happened to me more than once. I couldn't tell if this was an obtuse financial planner or if he was not very bright. Uh, he said that he liked the cash balance design, but he did not like the 401k profit sharing because everybody got 5% allocation. So he wanted the plan sponsor just to adopt one cash balance plan. And I was like, why didn't I think of that? You must be the smartest person ever. No, I didn't say it, I was thinking it. And the key idea is that we are very interested in using the 3% safe harbor or the 4.5% profit sharing and other non-elective allocations because we're thinking about it like, oh, that's 9% for the 65-year-old, or that's 12 and a quarter for that 65-year-old. We're looking at it very differently than you are, and ostensibly it looks like only 5%, but we're looking at it as a much bigger benefit rate. By the way, we're not interested in matching allocations because those are a function of if the employee defers from his salary. If the employee doesn't defer anything, then there's no matching and we get stuck with a 0% allocation. Next one, please. So why don't we take a poll? And the poll question is, what kind of retirement planning are you most comfortable explaining to the would-be plan sponsor? Go ahead and answer. As you're doing that, let me, well, no, go ahead and finish casting your vote. Is that everybody? Oh, we have 7 out of 9 participating. Okay. All right. So I guess I should continue. All
Yep,
right. I
I
will.
I closed the poll and it should be sharing right now.
All right. So I will minimize this, put it over here. All right, so a sample cash balance plan for ABC Company. This was a real case. HCE1 and HCE2 were really married, and the husband's a year older than his wife. We have 7 employees altogether. So at least 3 participants need to have the meaningful benefit, right? 7 times a point 4 is 2.8. We need 3 people. So that is HC1 and HC2 have it just by the cost for them. And NHCE5 probably has it. And maybe NHCE4 has it so that we passed it by an extra person. We were only able to provide 3% allocations to HCE1 and HCE2. We provided 10% allocations to the 5 employees. As you gather, providing 10% allocations to NHCE4 and 5 was like the equivalent of providing, say, 20% annuities to enable a pass. When we added that result to the pay credits that are between like 1% and 4.7%. So in this actual case that happened, 281,258 plus 164,227 equals 445,485 out of the total there, 474,033 was 94% of the overall contribution. If they really paid taxes on the 445, they would be in a 37% tax bracket between the federal and state income tax. So they decided, you know what, it makes sense to open up a plan, take care of themselves, and take care of the employees to some extent. Next one. Let me share the results that happened. We've got 71% that are used to defined benefit plans. That's interesting. There's no right or wrong answer here. I would say really that the not sures really have it and they're more appropriate. And nobody picked cash balance plan that they're comfortable with. In a way, I'm glad because I'm going to go over traditional defined benefits now, and it's going to form a connection to cash balance. Uh, so not sure were the ones that I think were right on track. To me, the cash balance versus traditional defined benefit debate is kind of like the analogy of I'm going to meet you at the restaurant at 12:30 p.m. for lunch. You could take your car on the interstate, get off the exit, turn off onto the main road, and be at the restaurant at 12:30 p.m. In my case, I might take my motorcycle trike on a route number or byway that runs parallel to the interstate, take some back roads, and meet you at 12:30 p.m. at the restaurant. And we just got there in different ways, but we arrived there at the same time. So we're both right. Therefore, uh, if you want to think about it this way, there's no wrong answer. Not sure is good. Traditional defined benefit plan is good. Cash balance plan, if anybody picked it, would have also been good. Uh, so let me talk to you. This is, I guess, what you came for. Let me talk to you about traditional defined benefit plans. All right. The similarity between a traditional defined benefit plan and the cash balance plan is that there are definitions again. That's it. An accrual rate is defined, an average salary is defined, and years of working with the plan is also defined. An accrual rate can be the meaningful benefit of the 0.5% I3. Policemen and firemen are known for, the radio ads like get half pay after 20 years of working as a policeman. So that's 2.5% times 20 years at 2.5% I3. And the maximum accrual rate that we showed for the 48-year-old, which is more significant now that I got this poll, is 10% high three. So go ahead, move on to the next slide. So here is our favorite example again. Uh, he is going to have the same normal cost, the 129,070, under a traditional defined benefit plan as the pay credit under a cash balance plan. This cost is still 129,070. I'll meet you there at 12:30. Next slide, please. Okay, so this is a defined benefit plan carve out, and we've got NHCE 1 and NHCE 4 inclusive getting excluded from the plan. So the plan document should have a shrewd way of excluding these four people. And we've got, the same seven people, the same husband and wife are HC 1 and 2. We need the three people to have a meaningful benefit. And so if four people are getting no defined benefit plan at all, they have to get an allocation uh, that makes up for that, you know. And as it turned out, giving 7.5% to everyone was sufficient to pass the average benefits test along with the other tests. So we wind up with HCE1 and HCE2 is 269, 644 plus 150, 623 is 420, 267 out of the 445.60, which is 95% of the overall contribution. The drawback is that the deduction for the HCEs was 445, 485. And a couple slides ago, it was 25,000 more than that, about 470, 700. But the cost for the employee benefits was 28,548 higher than than it is on this slide. No, I said that wrong. It's 28,548 versus 20,293 here, which is an additional 8,255 for the NHCEs. So if an HCE would be thinking strategically, he would say, well, the 440 versus 473, right? 470. If it costs me another 25,000, if I have to, for my 25,218, it costs me another 8,255 for the NHCEs. Well, that fraction is 75%. It's exciting, but not that exciting. If I would have paid taxes, I would be in the high 60s tax bracket. So it's kind of a toss up if they would adopt this carve out plan that's a defined benefit plan or the cash balance plan a few slides ago. So next slide. Yeah, questions. So in summary, I think that the cash balance plans are a useful tool to solve for tax deductions for all small business owners, but especially a core group of people in their late 40s to mid 50s that really need to make up for lost time in saving for retirement. Cash balance and traditional defined benefit plans work very similarly. Depending on non-discrimination test results, one might fare better with another retirement plan only by a few percentage points and slight differences in deductible amounts. So thank you for listening, and we'll take more questions if you got them.
Yeah, we do have a couple of questions in our Q&A. So, a few of them go back to earlier in the session. So, one person asked that 100K is, quote, in addition to his normal contributions of 24.5K. I think that was from their first slide. So,
Yes,
is the
that is a
100K
true
in addition?
statement
Okay.
because the 24/5 counts as an employee contribution. It doesn't get conflated with the employer contributions.
Okay, great. And then we have another one that says, so the income bracket matters then for this type of cash account.
We always try to solve for the most capitalist plan design that we have. We usually solve for 80% of the contributions being for the HCEs or the owner and or two partners or the husband and wife or whatever. And 20% is shared by all of the employees. So we seem to beat whatever the tax bracket will be. Once the tax bracket is only like a 20% tax bracket, then it's a matter of, I guess, showing goodwill to the employees. But the falsehood is if people are making like 400,000 a year, there's federal income tax, there's probably state income tax, and the combination of both of those is like 37% at least.
Okay, thank you. We have a few more. So,
Yeah.
how would you present or position cash balance to a client in an initial conversation?
I would say that your future self will thank your present self. You should save for retirement because one day you will stop working. Hopefully you'll enjoy the fruits of your labor for all of the years that you were working. And you enjoy a tax deduction for yourself. You set aside some money for your employees so that they're not completely dependent on Social Security. And it's good vibes all around. It is a miracle within financial services, within the financial services industry.
We do love good vibes all around. Thank you very much. We have a few more. So, would you repeat the benefits of cash balance for HCEs?
The cash balance for HCEs enable the HCEs to make up for lost time. Like in a 401k plan, if you're 50 years old, then you missed 25 years of making contributions. We saw the overhead where the 28-year-old was able to max out at 72,000. Uh, so now we have a 50-year-old and until he founded his business, until he took care of other affairs in his life, now he needs to save for retirement. We use the discount factor, the 1 over the 1.05 to an exponent. And because he's very close to retirement, only 10, 15 years away, we can use that to his advantage and make up for lost time. And we can solve for much larger deductions than the $72,000 limit. We saw the slide where the 48-year-old got like 129,000.
Okay, great. And then, what kinds of income are used for calculating benefits?
Uh, that's a good question. Let's talk about what should never happen. It happens more often than it should that a CPA approaches us and someone is in their late 30s and they're an entrepreneur and they have a profit of 600,000, but they only paid a W-2 to the officer of 70,000. And what do you think that's going to do? That the benefit is going to be a function of 70,000. Maybe we could solve for a $70,000 deduction when this person was in their late 30s. So I said, well, why did you do this? Why didn't you give them a higher W-2? And the CPA said that they were trying to save on FICA and Medicare tax, so they decided to make the W-2 only 70,000. So this was ill-conceived, and they needed to start the plan a year later, and they were better prepared with a W-2 of 170,000 and less profit, and then the profit, a lot of the profit was used as the tax deduction. So the employer is the employee at the same time. We need to have John Smith, the employee, have a big W-2 so that John Smith, the owner of the corporation, can deduct much more money on John Smith, the employee's behalf. Most other things we can work with. Uh, if there is a Schedule C, we have to split that up between what the employer contributes, John Smith, the employer, contributes on behalf of John Smith, the employee. So we need like 450,000 so the 250 is deductible and 200,000 is what John Smith, the employee, is earning. So that's how we handle a Schedule C, uh, how we would handle a K1. If it's a K1 and a W2, then terrific. That was the first example that I described. But we work with a K1 for partners that don't have a W2 as well. The key idea is they need to think of themselves as the employee and the employer. How do they take care of themselves as an employee would answer what to pay themselves so that they get a benefit that's a function of their pay as an employee. The Social Security Administration is not dumb. They want somebody to pay the maximum Medicare and Social Security up to the taxable wage base. So you should come up with like 170,000 when you are installing any kind of retirement plan.
Awesome. And then we have time for one more, and that is, can an existing retirement plan convert to cash balance?
An existing defined benefit plan converting to cash balance?
It just says retirement plan. Oh, yes.
Um, for our purposes in this room, the answer is no. Uh, if you have IBM on your hands and they're changing from a defined benefit plan to something complex because they concluded that their defined benefit plan is unsustainable for whatever reason, and they know they're going to have a plan for like 60 years. So it makes sense for them to go through this transition. But by and large, we're talking about people that have a finite number of years. They're going to have a plan 7 years, 10 years, 12 years. If they have an existing defined benefit plan, we should continue with that defined benefit plan by doing a plan amendment. If they have a cash balance plan as it's drafted in a plan document, we should leave the cash balance plan as it is. We shouldn't do a big overhaul to make it a defined benefit plan. And of course, everybody would agree that a 401k plan remains as a 401k plan.
Great. Thank you so much. So just for everybody, we know it's a complex topic, so please feel free to reply to the follow-up emails that will come after the session and after Divinity Academy wraps. With any questions, we can get you in touch with Dan and his team to get you the answers that you need. But thank you all so much for your time today. Thank you to our host, Dan. Divinity Academy's spring educational series is back tomorrow with how 316 services can enhance your value proposition by helping reduce plan sponsor burden, mitigate risk, can create a more complete service offering. So we look forward to seeing you all tomorrow. Have a wonderful afternoon and evening.
Thank you. Bye.